Good evening, everyone. This is the Pension Fund Investment Advisory Panel, the quarterly meeting. I'm the chair, Councillor Owen Pritchard, and we're joined by Councillor Mark Allison and Councillor Adam Bush as the voting members. We've also got Gwyn Isaac and Tina representing the unions, and we have Caroline Holland, who is the Director of Corporate Services. The number of other people will introduce themselves when they speak. Before we commence, are there any absence? There are no absences, but are there any declarations of pecuniary interest? Moving on to agenda point 3, minutes of the previous meeting. Only one correction, I believe, which is the correcting Councillor David Williams, delete and insert Councillor Mark Allison. That aside, are there any other corrections or any other comments on the minutes of the previous meeting?
We need to add Caroline Holland and Tina Pickard on the minutes as attendees.
Right.
Okay, thank you. Noted.
Anything further? In which case, I propose them. Can I have a seconder, please? Thank you, Mark. Moving on to the quarterly performance review. I will touch on it lightly, as obviously the majority of it we do in the private session. I'll draw people directly to page 3 of the page 5 of the pack, but page 3 of that specific report, paragraph 2.2, and that over the 3 months to June 2020, total fund assets returned 14.1% compared to the target of 1.2%. This equates to outperformance by 12.9%. Bear in mind that this is a bounce back from the COVID. The fund's total market value increased by 96 million over the quarter, from 689 to 785 million. Over the last 12 months, the fund performance was 4.2% and 3-year annualized performance was 5.9%. The annual performance target is 4.8%. I want to draw attention to a couple of things there. First off is the bounce back. That 785 million takes us to within 2 million of our all-time high, which was in December in the pre-COVID crisis. So the fund has in many ways demonstrated all the resilience we could have hoped for over the last sort of 6 to 9 months. And that although the fund performance was 4.2% and therefore 0.6% below the annual target of 4.8%, given the year that the financial markets have had, and that certainly the property aspect of the market is yet to recover, that's remarkably good. So again, demonstrative of the resilience in the fund and a compliment to both our to our officers, to our advisors, and to the strategy. Does anyone want to comment further in this part of the meeting on the quarterly report, mindful that we're going to go into some detail in the confidential part?
None from me.
Okay, in which case, thank you for that. I'm now going to add an additional agenda point, which is the introduction of the audit report by Ernst & Young, which has been moved forward to the to this part of the meeting. Caroline?
So just very briefly, Chair, the accounts and the audit of the accounts are nearly finished. So just finalising a few queries. Doesn't appear to be at this stage a qualified opinion, so that's really good. So I just want to take some comments, and obviously Suresh will introduce his report, but then it links with the overall annual business plan as well, which shows the overall performance of the fund and some data and analytics around membership and cash flow and things like that. So happy to take any questions, and Roger and Nima will also assist with any queries I can't answer as well. Thank you.
I thought it was Adam.
Yeah, no, sorry, Chair. Yeah, so you obviously point out that there are still a few queries outstanding, etc. When are we hoping to get those resolved? Because obviously, I note that the deadline has been pushed forward by the regulatory bodies, etc. Following COVID. Are we still on time to meet those?
you want me to come in there, Caroline?
Yes, please, Josh.
Yeah, so so the reporting date has been moved by MHCLG to the end of November, and we anticipate completing the outstanding work on the pension fund in the next week or so. So we're well ahead of that reporting date, and obviously the report that we've prepared for this meeting will be updated to go to the Standards and General Purposes Committee, or verbal update of the Standards and General Purposes Committee on the 22nd. So hopefully by then actually we'll have finished the pension fund audit.
Does anyone want to speak further on this point, on this agenda point at all?
Chair, did you want me to just highlight some of the key messages from
That'd be great if you would, Suresh,
yeah,
please.
that's fine. I've got my colleague Simon Luck, you'll have spotted at the bottom of your screen, who's can also just contribute to our item. So yeah, so our report is starts on the pack, page 25. And as Caroline said, we are substantially complete. The one complication this year that we've had across all pension fund audits is as a result of the triennial valuation that you mentioned earlier, Chair. We've been required to carry out some testing on a sample of membership data. So you'll see reference in the audit results report about a sample of 75 individuals that we then have to test, and that the idea of that is to ensure that the basis of the actuary's valuation, so the triennial, the data that underpins that is accurate and complete. So that, as you can imagine, the sample size is quite large. Some of the data we're asking for is quite old, because depending on the randomness of the sample, you can pick a pensioner who's been started work a number of years ago. So trying to find data to support their date of birth, for example, can be quite complicated. So that's the reason why that's taken longer, because I think it's taken longer for the administrative authority to actually collect that data, and we've got that issue across the country. So that work has taken longer than we anticipated. But like I said, that is currently in progress, and we've just raised some queries with Mashi today. So hopefully we'll get that sorted out soon. The other kind of key, I suppose, changes to prior year audits is the focus on going concern, which again is referenced in the report. And I think looking at the minutes of your last meeting, you talked about that. You'll see in the revised accounts there is now a disclosure around going concern, and clearly it references the triennial and the fact that you are 103% funded. So that was never about whether or not you are a going concern. It was always about the disclosures that you're making, and we're satisfied with the revised disclosure in your accounts. The other focus was on the post-balance sheet events, and that's really just asking, well, actually, given COVID, and actually links into what you just said about your performance of your fund, the bounce back, should you be referring to anything that's happened after the year end that you need to disclose? And again, you have disclosed in your revised accounts reference to that effect. So those are the kind of key changes. But if I take you to page 31 of the executive summary, that just kind of summarizes our reporting against the two what we call significant risks we identified in our audit planning, and those two areas of focus that I've actually just talked about. The one I did want to just pull out, and Simon's just going to quickly explain, is around the currency hedge, because I don't actually think we brought the plan to this panel because of the timing of the COVID pandemic, but we did identify that new currency hedge instrument as a significant risk. So Simon will just explain to you on page 35 of the pack what we actually found. Simon?
Yeah, hi. So we've originally raised a significant risk around the incorrect valuation and accounting of this new currency hedge because of the size, and also because of its nature as a potential level 3 investment. So management has originally classified this hedge as an overseas bond in the first draft of the accounts. But from our work, we have noted that this instrument is actually made up of cash, fixed income equity, and only a small portion is related to a level 3 investment. So therefore, there's a misclassification in investments in accounts, and management has subsequently adjusted for this in the accounts.
So we just wanted to highlight that because again, that was new for this year, and we did have some discussion about whether or not it should have been a significant risk. And what we're reporting obviously is the fact that the reclassification of that in the accounts. So the overall obviously the value of the investment is still appropriate. It's just a classification within the accounts, and that kind of classification is the only kind of what we call differences that we've identified as part of the audit. So nothing has fundamentally changed in respect of your draft statements. So Chair, we'll stop there and we'll take any questions if there are any.
I think Adam's got one.
Yeah, thank you, Chair. Thank you, Suresh and Simon. Coming on to this classification error, so I presume that was over the hierarchy or under FRS 102. So that was a brand new investment this year, and it was simply raised at your planning stage. That was incorrect. And so in terms of that asset, was there any elements that was judgmental or subjective that would split it into a variation across as the two asset classes?
I think the only elements that was ended up level 3 was the 6.7 million. Is that right, Namashi?
Yeah, it was the currency hedging.
Yeah.
6.7. So some of them were invested in the bond and some of them were cash waiting to be going to the bond. So when we're doing the accounting, we classified everything as bond, and because the 25 million was cash, and EY requested us to split and show it as cash and bond. That's the classification difference.
And the follow-up question comes around to sort of going concern. Obviously, I appreciate that the fund is over 100%. So in its own right, the pension scheme fulfills as the going concern requirements. So if the fund had been less than 100%, would your testing have been a bit more strenuous on the council's sort of finances to see whether it could sort of support its deficit going forward? Or was that still the case even though the pension fund's got a surplus? So basically the question is when you were assessing the going concern, on what element were you looking that the council could support the pension fund in terms of its contributions or its deficits?
I'm trying to make sure I'm not answering a question that relates to the council's accounts, which I'm not sure would be appropriate for this meeting.
So yeah.
But in terms of our consideration, in terms of the pension funds going concern, it was largely based on the 103%. If it was like you say 90-something%, then we would have done a bit more stress testing in terms of things like cash flow, access to liquid assets, etc. But
what could you, Adam? Where you sort of going? Sorry, mate. Are you concerned that given the finances of the council that we can't support our ongoing liabilities in terms of pension, or are you just curious?
So, in terms of is the going concern of the pension scheme, I've got no issues whatsoever. I was just thinking is that traditionally with a pension fund, the council would have to be sort of stress tested to see whether it could fulfill its
Okay, yeah, and therefore, given the huge financial pressure that all the councils in England are now under, does that put this and all pension funds under risk? Suresh, do you take into account the wider financial picture?
So the way we considered that, and the way we've considered that at all LGPS schemes, is we're looking at the admitted bodies, and are there any admitted bodies that are under severe enough stress financially that they wouldn't be able to fulfil their duties in terms of making contributions? And based on our understanding of your admitted bodies, clearly the main one being the council, which we also audit, we've got sufficient assurance around that.
Anything further? Is there anything further at all on this agenda point?
Could I just quickly ask a question? In terms of the judgmental balances around the pension fund, in terms of, I don't know, the judgmental investments, which were deemed a level 3. What extra work did you do in terms of getting assurances over? Was sort of counterparty valuations because obviously the judgmental side could sort of make it up or down in terms of a material balance. So yeah, just a quick few words on that, if possible.
So I'm going to ask Namashi just to confirm the numbers, because I can't remember off the top of my head, but you haven't got a significant level of level 3 investments. Sorry, go on, Namashi.
No, we do have only the private debt and infrastructure, which falls in the level 3, which we can't access the valuation on a day-to-day open market. These investments take slightly longer than the listed investment to the valuation to come through. Fortunately, all our investments, when we did the draft account, we didn't have the audited valuations, but by now we have updated the account with everything with the final valuation. So we have done extra tests, but no, there's no estimated valuation. Everything is accounted on the true value. Is that? Okay.
Anything for any subsequents, Adam?
I don't know. Thank you, Chair.
Any round the houses? Anyone further? Is there anything further you'd like to add, Suresh, Caroline, Nima, Roger?
No, nothing for me, Chair.
Okay, at that point, in which case we'll call that agenda point closed. Is there any other business for this first part of the meeting that anyone would like to discuss? In which case I would like to end streaming, please, on the grounds that the public are excluded from the second part of the meeting because the reports are not for public disclosure on reasons of confidentiality.